Hello and welcome to Property Matters. I'm Stephen Galpin, and today we're going to be talking about development finance in the property market. And joining me to discuss that is Michael Allison, Commercial Director of Roma Finance. Welcome to you.
Hi, how are you?
I'm okay. Well, look, what we're going to do, Michael, is go back in history to, I don't know whether it's 2008 or 2010, but certainly it was a pretty disruptive time. In the world of finance, and things changed big time at that time. Up until then, I think a developer would historically get his finance by perhaps persuading the bank that he'd got some pre-sales. Certain amount of pre-sales, often 20%, was needed, and if you could show that and prove that, and they were reasonably credible reservations, then you probably got your finance on a speculative basis for the rest of the development. But of course things changed with the crunch that came there, and since then, and certainly in the next 8 or 10 years, financing of developments, particularly on a speculative basis, became very, very difficult. Now, I don't want in this programme to talk about the public companies whose shareholders, institutional investors, are quite capable of financing their investee companies. I want to talk about SMEs, really, the smaller developer, the developer who has to go to the bank, make his case, get the money and put that product into the market, because I think that's the real world.
Yeah.
Okay. So that's where we're going. Now, we've got a target now from the government of 1.5 million homes by the end of Parliament. Are you finding that lending criteria is relaxing now to help that target?
I think lending criteria will always differ from lender to lender, because everyone has their own different appetites. People have their own history that they can recall on as well, about the right areas to build, the right properties to build. But so relaxing of criteria maybe is probably the wrong phrase to use. What we are seeing is that we feel that we're moving into more of a liquid market for the end user. So one of the things that's been hamstrung is the ability for people to actually get mortgages to buy the units in the first place over the last 2 or 3 years. So we are seeing in that space there are some relaxing of the rules, or some of the constraints that have been wrapped around since 2008 for the end user who's buying the unit, which has a knock-on effect to more liquidity in the market.
Michael, music to my ears. You've just hit on something there that I've been preaching about for ages, and it's something I've never understood about development finance. I mean, just to go back, I can remember in those years after the recession of 2010 or whenever, I was having banks saying, "Oh, too much for us, too strong for our balance sheet. You're going to have to syndicate this," which was a nightmare in itself. You know, you were dealing with half a dozen credit committees around the Canary Wharf here, and life was not easy. Okay, but I've never understood why the developer's lender would never finance the retail end of the sales. In other words, so he's built his product, he's put it on the market. Why doesn't that lender come in again and fund the mortgages? It seems to me you get 2 bites at the cherry. I suppose you're going to say to me that it's 2 bites of the risk, but nevertheless, I think it's a missed opportunity. And one of the things that has got to be considered with this 1.5 million target is that not only have you got to build these things, but you've got to sell them. Now, whether it's selling them to a housing association, to a rental operator, to private individual, doesn't matter, but they've all got to be sold. And if they're going to be sold, you've hit the nail on the head, you need the money to buy them.
It needs to go, any asset has to be going into a liquid market. You're going to be building an asset that's right for the area. So you need to be building it, don't build something out of kilter. Don't put £1 million home in an area where there are no £1 million homes. Or don't build £100,000 apartments in an area where every other apartment's £3 million. You've got to make sure it's relevant for the market you're going into. But liquidity is everything, the end user. And what that actually does, if you think about it, is it frees up other stock within the marketplace for other uses as well. So if somebody is leaving, think back to the old traditional property ladder, You bought an apartment, then you moved to a terrace, then you moved to a semi, then you moved to a detached, and that was the property ladder. You make your way up. Well, as people come out of that ladder, and the SME house builders are really good at doing this, providing smaller bespoke developments which are attractive to see, normally in the right areas. That frees up other stock within the market that either first-time buyers can move in and start the property ladder correctly, or it frees up great property investments as well, for those professional property people.
Yeah, well, of course, that's another thing, and that's appropriate architecture in the right place.
Yeah,
Get your developer building the right thing in the right place. Very, very, very important. Just another subject on the retail side of things, but I'm sure must apply to the development side. We get a lot of criticism these days about the time conveyancing takes. So you buy your house, you think, oh, take a month or two and I'll move in and we're all there. No. As often as not these days, it's 6, 7, maybe even 8 months before that conveyancing process is made. Now, usually your solicitor will come back and say, not my fault, it's the searches. You go to the people about the searches, they say, well, the lender's asking for more and more information, it's taking longer and longer to pull all these searches together. Are the lenders guilty of asking too many questions these days? Are they being too inquisitive?
I can only talk from a personal experience. The answer is no. Right. I think you're right, times are elongating with conveyancing. I think a lot of that is down to a lack of innovation as well. So if I think about the lending space where we operate, we have to assess an individual's credit, we have to assess the title, what we're looking to lend against, we have to do various assessments. Innovation coming in is that we should be able to press a button and consume that information directly.
Yeah.
Archaic processes that sit within the conveyancing or external to the conveyancing about things such as land searches, local search, etc. If that's archaic, it slows down the innovation piece. That's the bit that needs to be looked at, is the opportunity for, and it's easier in lending, but then there's 300 bridging lenders, some of which do development finance. We all know who the household banks are and the challenger banks. So when it comes to conveyancing, there's a lot more than 500, 600 players. So getting them all on the same page with innovation and all on the same page with technology is going to be really difficult.
Well, I've said it on the programme before. I often think that searches ought to be regularised and obtainable from one single place. And I think that place should be the land registry. I think everything should be placed there. And I think it should be paid for by a subscription from solicitors. So they've got a one-stop shop. They can get all the searches from the same place. Land registry could then control how that information is fed into them and how it's fed out to lawyers. And I think it would cut times down by half. I really do.
But then the land registry has to innovate as well.
Of course.
So if you look at the registration of new titles that are being created with development, very often, by the time we're looking to sell an asset or refinance an asset out,
still not registered.
Still not registered.
Yeah.
So there's more. Then they say, well, we can expedite it, but then the expedition dates come out further and further because we never caught up with that backlog. So it's a lack of innovation in the space to say, how can we make this easier for people to do? And your suggestion is a really valid one. But it should be done and backed by technology as well.
Sure. I mean, this is one of the areas that AI could play a tremendous part. I would have thought, but I think again it comes back to our sort of democracy in a way. You've got people on the front benches in government who are not experienced business-wise. They're leading departments and sectors of the governmental process, and they've got no commercial nous. I'm sure the amount of people in the land registry might be very good at understanding title deeds and drawing plans and registering plans, but whether they're commercially savvy or not is another question, isn't it?
Well, our goals are misaligned. You mentioned right at the start, the goal is to create 1.5 million homes. And you're quite right. Within that's the headline figure, and there's a lot of strategies that play its part. But if we're creating 1.5 million new homes, how is land registry going to cope? How are conveyancing going to cope? How is mortgage applications going to cope? If we don't innovate the overall process, it's the sum of all parts to lead us to the end of that point. It's no point saying we're going to build them and then hope that something happens. But if it takes 6, 7, 8, 9 months of conveyancing, if the charges aren't registered, the charges aren't created, if there's a backlog of registrations, if there's a backlog of applications and lenders can't cope with it, it falls down anyway.
Well, not only the practicalities of that failure, but of course the data that's coming out of that department, i.e. land registry, is so outdated that it's not helping any sensible assessment of what's happening in the market at all, is it? And I don't know how long after the end of Parliament it's going to take for them to work out whether they have built 1.5 million homes or not. Is another matter. The other thing that the government doesn't seem to be very clear on is when they say we're going to build 1.5 million homes. Who's we? Who is we? Who are they tasking with this? Because I talk to a lot of developers, I talk to a lot of buy-to-let owners, I talk to a lot of people in the property market, and none of them tell me that they're getting any particular assistance or help from the government to up the ante in terms of numbers. Are you seeing anything?
No, not at all. I think what we're seeing is more and more squeeze on the margin, certainly for the SME house builders. If you think about changes that stand outside of housing and creation of homes that make its way in, so you think procurement of materials, well, with the national insurance increases that's been seen, the builders' yards, the builders' merchants, that effect from the payment of their staff either has to go to the bottom line or the front line. So that gets pushed through. All of a sudden, the cost of doing business is increased just by a government change that was done over here. So we're seeing more and more margin squeezes, and actually deals don't stack as much as they used to. So it's hard for the SME house builders to get going.
Sure. Michael, unlike our viewers watching today, they haven't had the benefit of that I have of meeting you before and talking to you and your company before, and I understand and have seen firsthand that you're an organisation that does take a deep interest in your borrower, and I think that's terribly important today. It can apply to green issues, it can apply to construction methods, it can apply to how the product is fitting in the marketplace. And I know you're very concerned about that, and it's something that you as a company look at. Now, I don't want to get specifically talking about your company, but I do think that's an important factor in lending today, because hopefully we've moved away from this business of point scoring on credit, the sort of American tick box theory, and we're getting back to relationships. Because if we have good relationships and the lender understands the borrower and the borrower understands what the lender's requirements are, then we get a smoother transition through this whole development process. Have you got anything to say on that?
Well, I've got quite a lot to say on it, but I'll keep it short.
No, please do.
People in business crave relationships. They crave relationships because actually the art of doing good business is having strong relationships. As a lender, you can position yourself as being a lender-borrower relationship. You can look at it differently. You spin it on its head, and I'm going to use some easy maths.
Sure.
To make it easy for me. If a borrower is buying a property for £100,000, and they want 75% loan to value, and we give them £75,000 to purchase it, they put 25 in, and they're going to do some work, and it's going to be worth 150. We're either a borrower-lender relationship, or we're actually the majority business partner in that transaction. We've put in 75, they've put in 25, our interests are aligned because we want a great outcome for them so they can increase profitability for them and their business. We receive the profitability that we set out clearly to them from the onset in interest, etc.
It's a fixed return, yeah.
Yeah, and then we've got to focus on giving them a good time working with us. They've got to focus on giving us a good time working with them. We've got to be open and honest. And that's how you build a relationship. Because if we're all focused on the end goal and we're there to help them, if anything's taught us in the last, you mentioned 2008, certainly from that date, certainly in the last 5 years, we were talking off air, the amount of speed bumps that happen, it could be a snap budget that's done. It could be an invasion overseas that we see. It could be tariffs. It could be anything that hinders or affects the ability for people to procure materials, obtain finance, sell the end asset, refinance the asset. There can be so many speed bumps in the road. If you've got a strong relationship with those people you're in business with, you can help navigate it through, because you should still be focused on the end result. And I do think that going back to a relationship-led lending, obviously you've still got to lend to the right person. They've still got to be a good custodian of your cash. So there will always be the credit referencing, etc. But understanding who you're going into business with, that's how you know if you're going to get the success moment. And also that's how you know if you've got a growth partner that as you grow and they grow, you can share successes.
Now, you touched on something there, procurement. How flexible are you as lenders to listen to your developer borrower when he comes to you and says, well, I know I told you this at the beginning, but it's all gone a little bit awry. Are you flexible?
I think you have to be. I think you have, because there's a point in a development where the value diminishes sometimes less than what the loan is worth.
Yes.
Because, especially if somebody's taking an existing asset, complete demolition of it, and then to build 4 or 5 new units or 50 units, whatever that may be. There's a moment where you've got to stand together and work your way through it.
Do you have an AI type algorithm that calculates that?
No. We do it on good old fashioned history, what we've learned.
You got the beads.
Yeah, we got the beads, and you've got that gut feel. That's why you've got to pick your business partner right. And it all comes back to who you're getting into business with. It all comes back to that developer. If they're a backable person, normally they there's a good borrower or good business partner, they can create value in any asset. And a bad borrower destroys value in any asset. So pick them right first off. You're looking for people who have got a bit of liquidity behind them sometimes, because you might have to lend them more money. We might have to knife and fork our way out of this together. We might have to make some concessions ourselves as lenders, because we're really, lenders are really good at lending and builders are really good at building.
Yeah.
The last thing you want is a lender to take back a part-built site, because there's no value in it. For the next builder who wants to come along, they're going to want to nick it, because they've got to get the profit in the end.
Yeah.
It becomes unrealistic. And we saw that in 2008, 2009, 2010. Yeah. Certainly, there was a lot of areas in Manchester, as an example, as you go on the Mancunian Way, a lot of part-built apartment blocks just left there. They've been took back, but there's nobody to finish it. And that was a different time. But you've always got to try and think about, if something goes wrong, the person you're in business with, the person you've lent to, the person you've borrowed from, can you have a sensible discussion about how to navigate your way out of it?
And that is a very complex subject, isn't it? Very complex. I mean, I've done a lot of work for receivers over the years, and they have a very simplistic view of life. But putting right what's gone wrong in a development is not easy. It's usually gone wrong for a reason, and that reason is often not always that obvious until you come to rectify it, and then the cost really starts. And of course, the receiver often is not given the funds or given the freedom to solve those problems. So he's trying to sell an asset that's really probably even worse than the doomsday figure you've given it already. Becomes very, very difficult.
I think it does, but as well, it all goes back to your due diligence doesn't just start when you give somebody the money. Your due diligence goes as they're continuing to develop that site, regular visits, regular QS meetings, regular site meetings. And as you give your drawdowns, we like to, a good responsible development lender normally gives that drawdown payment in arrears of work's done. Yeah. So you get that sense of smell very quickly to say something's going off piste here, or things are taking a bit longer. So things take longer, it's going to be more expensive. The materials aren't on site that we expected to be on site. There's a delay. That's going to cause time and cost. So it's about working through that together and using our experience as a lender, or using a lender's experience, using a developer's experience, using the QS's experience, using procurement professionals who within your network who might be able to help you with that. It's about, sometimes you just got to face up to the task that's in front of you and get on with it.
Sure. But again, you mentioned a number of sort of professionals there. seems to me very important that you, one thing that hasn't changed since 2010 or before or after, you need your team of professionals around you, don't you? And again, I know that your company looks at that quite closely.
We do. Listen, again, because it's all about your network, who you're operating with, who is carrying out the work for you. Are you going into business with the right people? Because, well, like we said about the government before, the 1.5 million homes, every part of that structure that sits underneath it needs to have an aligned goal. Yeah. So if we're developing 50, 100 units, one unit, a conversion, whatever it may be, everybody involved in that, our lawyers, the borrower's contractor, if they're using a contractor, not doing their own build, the borrowers, where they're procuring the materials from, the selling agents, who they're going to use. Yeah. Everybody needs to be aligned to that goal and understand what we're looking to do.
Do you find that with your smaller developer, they're fully au fait with what's available to them? And I'll just give you an example of that. We were talking off camera about somebody that we both know in the procurement business. Yeah. And it was quite an eye-opener to me, the level of support that procurement firm can give to a small SME. They can program in what the likely increases are going to be. They can program in drawdown programs, storage programs. I mean, gone are the days you take your truck down to Allison of Roma and, you know, have a couple of guys chuck everything in the back and take it back to your site. You know, that's all over. It's gone. But do you find the smaller company understands exactly what's available to them?
No, they don't. And I think it's the jobs of companies like ourselves, like other people within that space, to really fight to put that message out there. And sometimes it's not always about touting for business. It's about sharing the knowledge. You know, I think one of the scariest things that, I'll just backtrack slightly, one of our personas that we love to work with are experienced tradespeople, blue collar workers who want to become developers themselves. So they've done extensions for people, etc. Now they want to do a conversion and off they go, and they want to be a developer in the future. The scariest bit for them is finance. They know where to buy materials, they know who to get to do the jobs, they know where they should be buying, they know the liquid market that they should be putting it into. They're a real good custodian of cash, but their mindset is you have to go to a bank and the banks don't lend. So specialist lending really helps people like that, and it's getting that message out there, I think.
I can imagine that, you know, again, with the smaller companies, they come to you to secure their finance, and they're thinking, well, you know, why is this guy talking about this, that and the other? They're a finance company. I just want to borrow the money and take the money and go away and do it. But it's not that easy these days, is it? It's got to be this sort of total overview of everything to be safe.
Well, it's to be safe and to make sure that we're all informed. Because as we said, if we're doing a 12, 18, 24-month scheme across multiple units, multiple things can go wrong, multiple things can go right. But it's making sure that everybody who's involved in that process are all aligned to the goal. And more importantly, if there's a gap in the process, that's where we should be, you know, not recommending, but signposting people to the right people who can help fill those gaps.
Well, they're called red flags, aren't they?
Yeah, red flags, there's an opportunity to introduce people there. Sometimes we'll have a borrower who we've dealt with, and a borrower over here, they face a similar problem. We can fuse the two people together, they have a coffee, they talk it through, and off they go.
Yeah. Okay. I just want to touch very lightly on something which is modular construction. Now, for the viewers that don't understand, that means you perhaps buy bathrooms pre-constructed in a factory somewhere else, you crane them into your development. It's highly efficient. It does have its problems over the funding, as to what point the funding is paid over to the producer of the actual modular product, and how it gets to the developer, and who owns what in the middle on the process. I know all that's very complicated, and we're not going to spend any time on that. But I'm just interested to know how you keep yourself informed of new systems that could be of benefit to your borrowers, and how you keep up to date with that, and how much you understand it, and how much you suggest or interject into that conversation.
Yeah, I think what we are first and foremost is we're always open to look at any method of construction, because it all comes back to, does it make the deal stack, and is the method of construction mortgageable? at the end. So can it go into a liquid market?
Yeah.
That's something to really think about.
Yeah.
If the speed bumps happen as the person that they're procuring the materials from, if it's the only person in the UK who does it and they've only been trading for 6 months, that's a bit of a red flag, because what happens if these suddenly... So you've got to look at the sum of all parts. But we know, for instance, you mentioned some of the things that's happening in the world, that in LA, after the fires that they've had, they're looking at more modern methods of construction for the rebuild, which are more fire retardant. So that means a new use of building block that will become standard over there, and there's opportunities to use it in the UK. But you're not going to use it if only there's one provider, if that makes sense. So we're always open to it, we'll always look at it, and we like to think of ourselves as an innovator. And there are other lenders in the space who are exactly the same. It's not just about putting up some concrete walls and off we go. You've got to be open to it, because the world is continuing to evolve. There's other targets about net zero. There's other targets about cost of living and bringing energy costs down. You've got to be cognizant that the building or the styles of building will change. But it's the SME house builders, because sometimes they're on smaller units or they're more agile, who can actually adopt them a lot earlier than maybe some of the larger house builders.
Are we moving to a position where the big banks are becoming less and less important to the construction industry? Is it going now to more... I know we have sort of bridging lenders, we have buy-to-let lenders, we have SME lenders. Is it becoming more specialised and sort of rather more focused?
I think it all comes back to, in answer, there's a lot more choice and opportunity for people than there ever have been. And certainly if the banks start to open up again and want to do more lending. But it all comes down to what that individual's looking for, that customer. Are they looking for relationship-led? Are they looking for price? Are they looking for leverage? Are they looking for speed and less questions? What is it they want? Because there is a lender out there for all of those types. So I think people, rather than in the past, if you pre-2008, they had a relationship, but everyone had to conform to one way of borrowing.
But that's because the banks themselves had a very limited focus on the market. In other words, they're a bit tunnel visioned.
Correct.
Again, tick boxes. Does this work? Does that work? What's actually going to be the profit margin here? That's a set criteria. But all that seems to have changed now, and I don't think the big banks really have the specialist departments at the accessible level that people need to be able to answer these questions and lend properly, really. I don't know.
Yeah, I can't speak on behalf of the big banks, but I do know is that what people want to do is have conversations with people and who can make an informed decision. Yeah. And that means that they want to be able to communicate however they want to communicate, face to face, pick up the telephone. But they want to be able to tell their story and find out, does the solution that lender have fit that story? And that's why there's been a big rise in specialist lending.
Yeah. Okay. Now, just on a sort of couple of generalities, if you like, we've seen quite a big exodus over the last 2 or 3 years, often due to tax changes and just attitudes towards the smaller landlord, an exit from the buy-to-let market. Is that coming back?
Well, certainly I think it's still an industry that's very buoyant. I think what you've seen is a transition of what a buy-to-let borrower is. So I think up until 3 years ago, until the famous SNAP budget that we had, but what we did see is, over periods of time, in the UK, we've always seen property as a sound investment. And the changes in the pension reform, which meant at 55 you could take a lump sum out of your pension, meant there was more and more people who were buying a house 2 streets away, so they could drive past their investment every day. Interest rates were at a level where they could easily be serviced, and people were buying them in their own name. And obviously things have changed over that period of time. There were unprofessional landlords but making an informed decision. So unprofessional in the way they didn't run it like a business, the buy-to-let. But they were very, very good at what they did.
But sorry to interrupt you, Mike, but this is really the old-fashioned theory of you buy property and you can't go wrong.
Yeah.
You can.
You can. Well, I think what happened is straight away, obviously, taxation rules changed, interest rates changed. COVID didn't help because there was moratoriums on rentals and etc. So there was a real toxic cocktail for those people. But now what we are seeing is a big return of the professional property people who perhaps were selling these properties in the high times. When it's high, sell. When it's low, buy. We're seeing people buying up portfolios. Some older people are exiting the market as well. Portfolio landlords who the family don't want to take it on, so they're putting their assets out. But we are seeing a big rise in buy-to-let, certainly more in that specialist end, multi-unit freehold blocks. And
I have to say, I don't think that's an unwelcome change. I think it does need to be run professionally. It is a business, no matter how casually you've gone into it. It ends up being a business. If you're not business-minded, it can cause you stress and difficulties. That then leads to, poor landlords, really. And I just think, you're dealing with people's homes. Great care is needed, and professionalism is needed. But I have liked the lending market's view to buy-to-let, which is to look at the actual business proposition rather than the person when lending. In other words, so you stress test the rent, you stress test the value of the property, not stress test the person themselves. So it does allow people to create their own informal pensions, doesn't it? Which I think takes a huge strain off the government in lots of ways, as well as providing, of course, homes for people that need to rent.
Yeah, I think when you're looking at a buy-to-let, you're always looking at it. Can the property pay for the finance with a buffer in there for any incidentals or interest rate rises? And if it can, it's a self-funded. If it can't, there's still opportunities for people to have those buy-to-let mortgages, but that's because they've got income from other sources that they can easily push into those properties.
Okay. Now, Michael, I want you to get your crystal ball out. Okay. And I'm going to say to you, what's your view on interest rate levels, shall we say, for the period of this Parliament, which is the relevant period for most things we're talking about today?
Well, I think, again, the crystal ball, I don't foresee this government or this term of government having 3 prime ministers. So I think we're more likely to have a stable government, stable leadership over the 5 years, whichever you
for better or worse.
Yeah, whichever your political persuasion. Yeah. I don't think we're going to have the chopping and changing of different directions. We won't know what else can happen in the world that can affect it. But certainly, I think, as we saw in recent weeks with everything that's going on, there is a market sentiment. So fixed rate mortgages have started to come down because people are baking in that interest rates will go down a little bit sharper than we were expecting at the start of this year. We will not. I don't envisage us having a return to 1% and 2% over the term, but probably stabling out during the course of this year. We might get under 4, and then see ourselves out into maybe patterning out to about 3.
Yeah.
No great shakes. I think one thing we are getting from this government is that there's no real panic button for them at this moment in time. They're sticking to what they've said they're going to do. They've given some unwelcome surprises, very unwelcome surprise, stamp duty, national insurance, but they're there now. We have to deal with them.
Well, when I was growing up, I was always told that anything under 10% was pretty cool. And you could calculate it.
Yeah.
So shall we just say for today that if it's under 5%, it's pretty cool?
That's it. There you go. Yeah.
Good. Okay, Michael Allison, thank you very much for coming in. Michael, as I said earlier, is Commercial Director of Roma Finance. I know you got up very early in the morning to come and see us today. Thank you so much for that. And thank you so much for your input about the world of finance.
Pleasure. Thank you.
I'm Stephen Galpin. Join me again next time on Property Matters.